Hello, this is Doug Gerlach, the editor-in-chief of the Small Cap Informer stock newsletter. Today is January 15th, 2025, not 2024 as it says on the slide. This is our 2025 Outlook webinar for subscribers of the Small Cap Informer, where we'll be talking about what we can expect in the year ahead, perhaps. We'll be releasing our top stocks, top small cap stock special report, and going over new features on the Small Cap Informer website, and taking a look back at everything that was 2024 related to the markets and the economy. Russell Malley, who is our assistant analyst, is on board in the back office, but if you have questions, feel free to type them into the questions box at any time. There's also a PDF of the slides for the presentation, as well as your first issue, the early release of our top small cap stocks report that you can download there as well. Just look for the handouts tab in the GoToWebinar application. As is my practice, I like to look back at the stock market performance in 2024, the year gone by, what worked, what didn't work, how did small company and large company stocks perform, and the year was pretty much a continuation of trends we've seen in the last 4 or 5 years with respect to large cap and small cap stocks. In this graph, you can see the blue on top is the S&P 500, which ended up a respectable 23-24%. The pink or magenta line is the EFA, the Europe Australasia Far East Index, which tracked along with the S&P 500 for the first half of the year and then slowly deteriorated after that, and maintains its tradition over the last few years of trailing U.S. markets with those developed country large cap stocks. And then the orange line is the S&P Small Cap 600, which trotted along for the first half of the year, and then things were looking up, but it ended the year down from the peaks that it reached, about 7 or 8% up for the entire year. The late market rally that small caps attempted after the Fed announced it was lowering rates, didn't really hold. Small caps ended up the year 6.95% compared to large caps up 24.01% for the year, and international large caps, that EFA up just 1.48%. The mega caps, the Magnificent Seven, were again the story in 2024, helped push that S&P 500 to new heights, and the rate of return of the S&P 500 because of the performance of those stocks was more than double the return of the S&P 500 equal weight index, which was up just 11% for the year. So that's the S&P 500 with all 500 stocks in equal position. You can see how it trails the S&P 500 market weighted. This is the value to the S&P 500 of including only the biggest stocks in high proportions, and the rest of the 493 stocks in much smaller positions that don't really have as much impact on the overall index. So again, the story is large caps did okay, ending the year at 11% on the S&P 500 equal weight. That's right in line with long-term market averages. But the S&P 500, again, another year of outperformance from large caps in the US. Of course, the long story is remains the same. It's been some time since the early 2000s, really, when the S&P small cap, or 2020 rather, when the S&P small cap 600 outperformed the S&P 500. But over the longer term, we can see the three have very distinct histories. And this is why we like to include an exposure to small cap stocks in our portfolios to provide you with the benefit when those small company stocks do outperform the large company stocks over the course of time. I see that Bob asks about whether it's appropriate to take the Magnificent Seven out to get more accurate view of large caps, and I think that's exactly what this slide is with the equal weight index. So we're not taking them out, but we're not allocating any more to them than to every other company. So certainly this is an alternative view of large company stock performance by looking at that equal weight index. And that's why I include it. That's why increasingly I'm suggesting that clubs might track their performance against the S&P 500 equal weight index as opposed to the S&P 500 index when they're looking at your benchmarking and performance in my iClub. But I think that's a valid point. And the concern is, of course, that those Magnificent Seven stocks aren't going to hold up at those levels indefinitely. But we'll talk about the bull case for 2025 in just a couple of minutes there. Let's take a look now at the economy and what's going on. I'm still in the low risk of inflation and recession camp since 2022. As you know, I've been on pretty much on board consistently with a position that the risk of a significant, a deep, or a lengthy recession has been pretty low, that enough of the economy was performing well enough despite headwinds in some other sectors that I didn't see we would have any sort of significant economic slowdown. But the economy does include lots of moving parts, and so the doves and the hawks both can selectively point to economic indicators to support their particular positions. And what's interesting is that consumers have, in some strata, particularly lower income consumers, have been behaving as they do during recessions, cutting discretionary spending. Even middle and upper income households have been not spending on new homes or building pools or buying a boat or an RV or upgrading those. And so the impact of that reduced spending has certainly impacted a number of economic areas and markets and industries and sectors as it would during a recession. And I was thinking of this as a pseudo recession behavior, and this is actually a phrase that some equity and analysts and economists have been using with respect to the post-pandemic economic activity in the United States. So I think the relative strength indicators across the economy suggest that things can continue to improve. There may be hiccups along the way. And of course, there are a lot of wild cards now with the regime change in Washington, D.C. And there are no predictions that we can really make about where things might be turning, but we can certainly look at the data that economists and the Fed is looking at, that stock market pundits are reviewing, to see what it tells us about the economy going forward as it has performed in the past few years. First, let's talk about inflation. Everyone's talking about inflation, and still you can see on the far right, the inflation ticked up pretty significantly to around 5%, and now it has dropped back down to under 3%, which is a pretty healthy rate of expanding prices. That's still much higher than most of the 2010s, but it's in line to where inflation was in the 90s and into the early 2000s. Part of the issue, my take on the issue of rising costs and how consumers have dealt with it, is that no one remembers the last time that costs went up at a greater rate, and it's been, for the last 20 years, it's been going, inflation has been well managed in the U.S., and so prices tend not to go up too much over time, and efficiencies then bring those costs back down, and the increase in costs tend to deliver more functionality. For instance, if you think about a computer, you can spend $1,000 on a computer, and what you would have gotten for that $1,000 back in 2002 is very different from what you would get in 2025. So much more functionality, more features, etc. Uh, but when it comes to basic material costs or food costs, the costs of living that address a lot of consumers, there definitely there's a perception amongst many people that costs are going up, and and that is certainly the case for certain segments. Egg prices are a concern. And we're going to be looking at and watching closely how food costs increase without itinerant labor to do the harvesting. What's that going to cost us at the grocery store later in the year? So there are some questions there, but the graph tells us that inflation has been declining from those peaks, those post-pandemic peaks. And I think going forward, there's going to be some very interesting, economic graduate student research into what was going on in the economy after the pandemic. Was it a case of companies raising prices due to the uncertainty and not knowing where their businesses were heading? Is it the result of reshoring activities or stocking up on supplies? Uh, or simply profiteering, companies raising prices because they could, because everyone else was, and they could blame it on the supply chain and thus increase their profitability. We certainly saw a lot of corporate profits growing pretty well in the last few years. If you look at this graph, and this is billions of dollars. If you go back to 2010 or 2020, the corporate profits for non-financials in the U.S. was over $400 billion, and in 2023-24, it's $2,400 billion, a six-fold increase in 15 years. Pretty significant, I would say. And this is part of the bull case for why large cap stocks can continue to perform, because they're making the money. If the company's making the money, then the share price will likely go up. But this is definitely a trend that has been in place, but you can see that uptick post-pandemic when profits just really ratcheted upward, and they're still on an uptrend. So the concern, of course, is that any kind of hiccup there, those earnings start to fall, and then stock prices will follow. Americans are working; they continue to work. This graph goes back to before 1950, and you can see the drop off in employment during the pandemic, but then it increases, comes back up to all-time record levels, which have been sustaining over the last couple of years. So that's a good sign. People are working. Unemployment likewise is historically low. On this graph, I've marked the current unemployment rate and where it stands, so you can see where it stands vis-a-vis the history going back again to the 1950s. The gray bars on here are the periods of recessions. So unemployment had fallen even lower. The Fed's position is that unemployment at this level is pretty good. Once it starts to get too much below this level, then it gets more expensive to hire people. Businesses can't find replacements. And so this is a pretty healthy level. You can see that unemployment rate is ticking up just a little bit, but it's still well low compared to history and compared to the Fed's target. On the housing market, we've seen a consistent recovery since around 2010, 2011, following the 2007, 2008 financial and housing markets bubble bursting, and you can see the drop off, but it's been pretty steady and since that time and continues to grow, but it's nowhere near the peaks of where those annual units completed were back in 2006 or so, or even back to the 1970s. That's contributing to the greater housing shortage, where people want to buy homes, they want to move, but there's no inventory. They're holding back because of mortgages. Sellers are resisting relocating because they don't want to give up their low mortgage now for a higher mortgage, and so that's influenced supply as well. But I think there's a lot of pent-up demand in the housing industry that's going to, at some point it's going to turn around. Now in November, housing sales jumped, 5.5, 5.9%, something like that, which is pretty strong. And I attributed that to um, a lot of pent-up demand. And when interest rates got cut, a lot of buyers and sellers alike said, well, okay, maybe this is our chance. The Fed's saying it's not going to cut rates much more, maybe 2 times next year. So if we wait, there's probably not going to be a big savings for it. House buying, just like investing, relies on uh, individual psychology and consumer behavior, and so it's easy to consider that people were taking advantage of it. But there's still plenty of room to go in terms of housing and housing units. Here's the mortgage rate graph. I often joke that there are those of us who are, in their 60s and 70s and in 80s remember buying a house in the 70s or 80s or 90s and, paying mortgage rates that were 10, 11, 12%. And now people are complaining at 6.5%. Yeah, it's a different market. I understand it's a different atmosphere. The whole nature of construction and what is desirable is much different now, but it's still pretty low. And I don't expect those mortgage rates to decline too much over the course of 2025. And I think a lot of home buyers are thinking the same thing. Consumer sentiment is a little troubling at how low it is. This is the University of Michigan's consumer sentiment report. And you can see, again, going back to the early 2000s, so you can see during those gray bars, during recessions, during the pandemic, consumer confidence falls off. And then post-pandemic, on the right, you can see the confidence, the consumer sentiment going up and then dropping off a cliff again into 2022, the worst levels in 20 plus years. Consumers in 2022 were feeling that the prospects for the economy are low, that they're not at all optimistic at that 50 level. Just kind of amazing. Everybody's working. Inflation, yes, is a concern, but it has been steadily improving post-pandemic, and yet people are holding off on making major purchases. They're holding off on relocating, and there's a general sense of pessimism about the market. If you think back to that longish recession of 2008, 2009, the bubble bursting in the housing market, then mortgages going under, homeowners, having to walk away from homes, financial firms shutting down, major banks, and if that doesn't make you feel pessimistic, I don't know what else would. But yet, consumers relative to this sentiment survey were much more pessimistic as the sentiment bottomed out in 2022. So I think this, doesn't answer the why are people so pessimistic, but we've got there's a lot of reasons for that might be perfectly valid explanations. But hopefully this will continue to improve, and that will again provide benefits across the business spectrum and translate to the stock market. James points out that the corporate profit graph should probably be logarithmic, and absolutely, that's the way the Fed presents it on the FRED website, the Federal Reserve Bank website. But I had that same thought as I was looking at it there. What's the ticker for the S&P equal weight index? Claire says, and the ticker for the ETF that tracks it is RSP. And you can use that in My iClub in the custom ticker field to track against against that index if you want to compare your results to the equal weight index. RSP is the ETF for that particular equal weight index. All right, let's jump into my outlook for 2025 and beyond. I like to start with the PE ratio. You hear words from market watchers about the elevated levels of the S&P 500, and here's a graph that kind of illustrates what those are. You can see that the current PE of the S&P 500 based on estimated 2024 earnings is 29.77, which is the pretty much the highest of any um, quote unquote normal period going back to the end of the 1990s into 2000 bull market, right before the 2001 NASDAQ crash bull market. And we see valuations tick up before that fall off. We see the 2008, 2009, see the P ratios jump up as businesses were struck by the recession that we had then. They've been slowly building back up during the pandemic. They peaked there as well, but now they're building their way back up again. That 30 PE would have been considered inconceivable in just about any market before the late 1990s. It would have been probably cause for panic if valuations reached that particular level. But that's the state of the market and how investors are approaching the PE ratio. And there's, I think that's, we'll talk more about the bull case and if that's sustainable or not. But if you look at the last 20 years of the PE ratios, again, you get that up climb from 2011 through to 2020 when the pandemic struck. So that's sort of an outlier. And then the P ratios dropped back down to around 20 by 2022, and then have been slowly expanding once again. They've fallen off a little bit at the end of the year, but they are still pretty elevated. But earnings are really the question. If earnings can continue to grow, they can support rising stock prices, and corporate earnings have been growing. This is a graph that goes back to 1870, and you can see it on the right. They've fallen off a little bit from the peak, but those earnings are still pretty significant and moving upward in the right direction. While meanwhile, treasuries have been increasing since 2020 as the Fed was raising rates. Still now at 4.79%, and you can see where that tracks again. Prior to the 1960s, that was a very, very high treasury rate. From the 60s through the 1990s, that would have been very low, and then we went into the periods of super low interest in the 2010s. But that rate kind of tracking back up. Is that rate enough to pull back some investors out of the market and into bonds? Not if we're delivering 23, 24% returns in the S&P 500, and if you own the Magnificent Seven, your returns might be boosted even more than that. I don't think 4.8% is enough to drag people away from the prospects of those types of returns. And so I think that still supports the growth of the stock market throughout the year. Yields at very close to an all-time average low for the S&P 500, 1.26. And this is a factor, of course, as the price of the shares, the market cap of companies goes up, the yield, the percentage of dividends of earnings goes down, or percentage of dividends of the stock price goes down. And so companies like this, they don't like paying dividends unless they've reached that mature growth stage. But this calls into question all sorts of dividend approaches to the market. Unless you really understand how supply, demand, how rising stock prices, how economic swings, how the value of treasuries impact each other and are all intertwined, then investing solely for yield is probably not a fantastically great way to build long-term wealth, especially after taxes. So that trend continues, and we see that as it falls off. Now, this is from a survey of investment banks about what they expect the S&P 500 to be at the end of the year. It closed at 58.69 or thereabouts. Everyone's positive except Stifel at 5,500. They're seeing the market dropping a few points between now and the end of the year, but everyone else on board with pretty significant gains, 10% or more in some cases. The light blue line in the middle, there's an average 66.27. The median of all of these estimates is 66.83. And Oppenheimer, exceptionally bullish, followed by Deutsche Bank, Wells Fargo, and Ed Yardeni Research at 7,000, Evercore ISI at 6,800. So there's a lot of optimism about what's to come for 2025 from Wall Street. On the one hand, since the contrarian side of me says, well, if everyone is that bullish, maybe it's time to be bearish. But we'll see how things turn out. Last year, just as a point of reference, almost no analysts called the 24% gain in the S&P 500 for the year. They were all, back in that 10%, maybe a little bit extra territory, which is a nice, safe, long-term guesstimate about the growth of the S&P 500 in a single year. So markets, there's a lot of optimism built in there. So what's the case for a recession or for a bear market for large cap stocks in 2025? Well, certainly from the economic perspective, a recession surprise is not off the table. I still believe the risk is pretty low, but there's a lot of factors that could stimulate more of that recession behavior or convert that pseudo recession that I mentioned into a full-blown recession. Inflation is not completely under control. I think we all understand that, and there may be some arguments to be made for how the Fed measures inflation, what their groupings are of personal consumption expenditures, and what those should be made up of. But inflation is still very much part of the narrative. Lots of potential for even more geopolitical drama on the horizon, which could impact some international holdings. Also could have some fallback on American stocks, American companies as well, and tensions with Russia and China and Ukraine and the Middle East, and that all is just not what the market wants to see. Global trade wars, if they do break out, if we have some tariff battles, those tend to have a pretty significant impact on consumer prices and corporate profits, and the way that things are headed according to the language that we're hearing. I have big concerns over the impact of tariffs, the impact of all sorts of additional trade wars, the costs of reshoring, resupplying with domestic suppliers. There are benefits, I get it, of charging more for imported goods, but if we don't have the capacity in the country to build out and meet the demand, then prices are just going to go up with no relief. And when we've got that type of inflation, it gets very difficult for the Fed to moderate it by managing interest rates. And so I do have concerns there. Those high valuations of the S&P 500 is setting up a scenario where companies have to execute perfectly, right? All it will take is for 2 or 3 of those Magnificent Seven companies to have some hiccups, and now the Magnificent Seven is down, the S&P 500 is down. Investors get get a little bit spooked and start to panic sell. And next thing you know it, we're in a correction. Next thing you know, we're in a bear market. And there are certainly factors on the horizon. Google's antitrust case, are they going to have to do some splitting up, sell off some products? What's that going to impact their bottom line? How will the market react to it? Certainly Tesla is having all sorts of strange issues with respect to cars that set themselves on fire, and vehicles that are dangerous to drive in or to auto drive in. So there are lots of scenarios where you can see those companies kind of stumbling. We had a little NVIDIA scare in the last half of 2024, but looks to be pretty temporary, and certainly all the factors that are driving the chip industry could continue to boost the Magnificent Seven and the S&P 500. Strapped consumers, this is the consumer confidence is low, and so even though everyone is working and wages are going up, they're saving more, delinquencies are going up on credit cards, they have that low consumer confidence. This is all just kind of a murky, amorphous, kind of unmeasurable impact on investor and consumer behavior that leaves kind of a wild card, but something to watch out for, certainly as we head further into the year. Now in the bull case, the corporate earnings growth appears pretty solid. Companies have been becoming more efficient. One of the upsides of low unemployment is that companies have to become more efficient because they can't fill every available spot. So they may consolidate jobs, take 3 jobs, turn it into 2 positions, and it becomes more efficient. So those factors are still, very much at work, very dynamic, and could have a good benefit. Cloud computing, artificial intelligence, generative AI, these are all trends that are helping as well to improve corporate productivity. They're helping companies to automate, provide for more efficient staff. I'm a little dubious of companies that are claiming that they're deploying artificial intelligence and replacing hundreds or thousands of customer-facing staff. I'm a little dubious of those particular claims, but you can also see the benefit of it. And again, I think there's going to be concern about the potential downsides of artificial intelligence, and as people become educated on using it, will there be regulation? There's already the president just put a ban on importing chips that in AI technology outside the country. So will that crimp some of the AI buzz? Remains to be seen, but certainly so far it's had a positive impact and is expected to drive a lot of large caps and their stocks throughout the rest of the year. Inflation trending downward, again, doesn't mean the prices aren't going up. Inflation is the rate of growth of the change in prices. So when we talk about 2% inflation, that means prices are going up 2%. It doesn't mean that prices are going down. That's called deflation, and we don't want deflation. Deflation can have a lot of serious side effects. So inflation is trending downward. That means that prices don't go up as quickly and is not as noticeable. Lower interest rates could boost corporate spending and earnings. Often has an impact on small company stocks, especially if their cost of capital can be reduced. The Fed signaling that they're not going to pull down rates as quickly as some people had hoped means this might have less of an impact, but it certainly is better than we were 2 years ago, than we were last year. So companies that are able to reduce their cost of capital could benefit, and that would be very, very good for their prospects. Consumers are going to continue to spend even if that is at a more moderate pace, and that's not likely to restart inflation. If everybody starts going out and hoarding toilet paper and other staples, the cost of those goods goes up without any sort of real tangible benefit. But if consumers are kind of behaving the way they're behaving now, that's going to continue to boost a lot of companies' bottom lines. And then there is a lot of talk about, quote, pro-business policies from Washington that could lift up corporate profits. And so that would be a benefit if it happens, but it's a tangled web that we weave, and there are lots of downsides, potential downsides, and value traps, and other concerns about things that are coming out of Washington later this year. For small caps, the bear case winds down to the fact that small caps haven't outperformed large caps in now 4 years into 5 years, and a lot of people think it's time for a win. I mean, the numbers all say small company stocks are selling at really inexpensive valuations. But if you can hold a nice quote unquote safe portfolio of large cap stocks, if you buy into the rhetoric that the stocks always go up and you can buy anything, as long as it's a good company and it'll increase in price, not worry about valuation. As long as that trend continues, then there's no reason to go downsize to small company stocks. And so there's just not a driver for demand of small company stocks just yet. And I don't know, we'll look at valuation in a minute, if this isn't cheap enough to attract people to small company stocks where the S&P 600 is right now. I don't know what it is. So we're going to have to be patient in that area. If, as I am concerned that volatility may tick up in 2025, that might also not be a good sign for small caps. They tend to get smacked around during periods of higher volatility, greater volatility. And so that could be a reason that people are a little more afraid of small caps right now, where we are in the economic cycle, where we are in the business cycle, where we are in the stock market cycle. So that might keep holding back small caps as well. So on the good side, if the economy continues to show strength, that will certainly help small company earnings. If interest rates do get reduced, and if there are some pro-business regulatory changes that come out of Washington, that might boost some small company fundamentals. Right now, the low stock valuations offer lots of upsides. I think in our top small cap stocks list, there's nothing selling at a PE ratio much above the mid-20s, I don't think. So there's lots of upside for companies that are offering double-digit earnings and revenue growth. There's some pontification that demand for discretionary purchases like RVs or boats and swimming pools, et cetera, may have reached the bottom. That suppliers are starting to stock up. They're starting to see some more demand. They were selling out their inventories because, and there was no need to restock shelves because demand wasn't there. But now they're starting to, have gotten rid of the inventory they had and are seeing more demand. So, glimmers of hope for those businesses in the consumer-facing industries and sectors could show some gains in 2025. Here's the PE ratios of small versus large stocks. The S&P 500 at 27 right now, based on trailing earnings, and the S&P 600 at 17. Now, at the start of last year, the small cap PEs were at a PE of 12. So they'd made it to 17, which is pretty good, but it still says there's a lot of room for valuations to grow on the small cap side. So whatever happens in the market, of course, we always say maintain your plan, stay the course. The stock market is a marathon, not a sprint. So we got to be in it. We got to be owning companies that grow their earnings over time and then see their share prices grow over time as well. We like to focus on higher quality companies relative to peers and avoid buying stocks only because of the near-term catalyst, unless you have some sort of plan to mitigate volatility or an escape plan to get out of it if things turn south. I constantly hear people saying, want to know where are the opportunities to invest in lithium that's used for batteries, or AI, cloud computing, blockchain, cannabis, whatever the theme of the day is, and electric vehicles. And there's certainly a lot of growth opportunities out there, but when you look at cloud computing, for instance, the biggest players in cloud computing are Amazon, Google, Microsoft, right? I mean, there are no small niche players that are going to come in with a global solution to provide access to data and services over a wide network like those businesses. So it can't, there can be small players who are coming in, but it's very tough to identify any sort of entry level investment in those types of themes around building a portfolio. And know that the market may suddenly reverse. I've been thinking about what drives bear markets. And when you go back in time and you look at the catalysts, they're really all over the map. And those catalysts are different based on the different confluence of circumstances, both from a market valuation basis and a fundamental basis and an economic basis. And so there's no predicting. You're not going to get an invitation when a correction arrives, but you just have to be prepared for it. If you're holding a lot of overvalued stocks, I think that's a big concern. A 20% haircut in the Magnificent Seven we're talking about billions of dollars of market cap. And if that happens quite suddenly and feeds on itself, then we'll have so a lot of change in investor behavior, a lot of fear, a lot more panic selling. And, for long-term focused investors, that can be a terrific opportunity, but you got to be ready for it. You got to know that it is indeed a possibility. All right, so Russell's in the back office. I see a question from Kevin. I'll follow up with you directly on that. And let's talk now a couple of new features in the SmallCap Informer newsletter. One we released in the last issue, Evaluation Watch section. I really wanted to focus on some of the companies that have very high valuations, because those companies have very high downsides. And our strategy is to hold during periods of overvaluation, whether it's because of the market or whether it's because of the company's own fundamental success. But I think it's important to identify those companies so that you can take advantage of any sort of downside protection, like a trailing stop loss order that you might want to put into place, or to lighten up on positions if you're doing tax loss selling, for instance, or you're doing trying to harvest some gains and or losses. Knowing which stocks are probably the first place you should check into can be useful. By definition, overvalued stocks typically have several of the following. They have a PEG ratio, a projected PE ratio greater than 150% of their average PE ratio. Not a PEG ratio, but a PE ratio of the relative value. The reward to risk ratio less than 1-to-1. The total return less than that 5% a year risk-free return you can get from a short-term bond or cash money markets. Maybe a little more than that. I mean, if you're holding a stock and you can get 6% and you've got a potential risk of 20% or more on the downside from a market correction, then it doesn't make a whole lot of sense. So you have to look at the tax impact of it, but you could be getting that 5% or 6% from a CD or a money market perhaps with no chance of a downside really, other than opportunity cost. The current price near or greater than the suggested sell above prices on our spreadsheet. Here's the narrative and the first stocks just to give you a little explanation for it. We're working on the background. We're working on uh, can we develop a rationale for stop loss orders that would on the trailing side that we might recommend deploying on some of these companies that are in that overvalued range. But we'll leave it for now. That it's tricky because every subscriber might be managing their portfolio different. They might be in a taxable versus a non-taxable account. It might be a core holding. It might be already shuffled off to the speculative a portion of the portfolio. And we don't do portfolio management. We're doing the research. But I think identifying those stocks is useful. So we will let me know how that works for you. We've also added an open positions report if we want to look at all of the current recommendations. So not only the covered companies, but each time we recommended them. They have the performance tracking, the gains since the recommendations were made. The dividends are added as well. You can sort that report. So people have asked about that. They want to see part of it, the track record. And that includes the stocks. We've got some stocks that are down, 30, 40, 50%, but we've also got some stocks that are up 500, 400, 300%. And those are obviously stocks that underperform tend not to live in the newsletter forever. Stocks that overperform, that outperform, tend to sit in there, and those performance records are all accessible now. So that's look in the subscriber tools section of the subscriber homepage in the bottom. There's also the closed position. You can screen the stocks as well that are in the coverage list. Here's a somewhat obfuscated snippet of that open positions report, so you can see when we recommended it, the buy date, which is the next business day after publication, the closing price, and then we invest a hypothetical $100 in every holding, and then we track the dividends over time. So this is how we determine the performance of the newsletter as an amalgam of all the positions that are opened.